Ooh, maybe you can see me a little bit, huh? Whoa. Oh. Mhm. Lee. Look who's here, Danielle. How you doing?
Good. How are
Nice.
you? Can you hear me?
I can hear you loud and clear. What you got
Oh, good.
you got your Mickey Mouse ears going, huh?
I do.
Looks like you're doing pretty well in the class. Is that a fair thing to say?
Yeah, I think so. This class is easier for me than my microeconomics class, I would say. Not easier, but it's like my brain kind of absorbs the information a little bit easier. So,
In this class?
yeah.
That's good. We don't often hear that.
Really? Yeah. I mean, it's a lot. Like the chapters are long and there's a lot of information going on, but I feel like
Yes.
it's a little
Yep.
more straightforward. So,
Good. Hi, Kate. Can you hear me?
Yes. Hi, everyone.
Hello, George. How you doing?
Pretty good.
All right. And we have Callie here. And hi, Callie. Wow, we got a big 5 so far, huh? And what time is it? I would assume, oh, Edwin. Edwin's here? Hi, Edwin. Can you hear me? Do you want to unmute yourself, Edwin?
Hi, Bob.
Hi there. Hi, Giovanni. How you doing?
Good and you?
Good. You're the animal guy, right?
Yeah.
Okay. You want to show your mug?
Not today. I'm looking a little rough.
Okay. All right. I guess we're ready to start then, huh? We have 6 participants. Edwin was here briefly. The subject is Chapter 7, And it's on depreciation expense and capitalizing assets. A couple students asked me to look at a problem they were having trouble with, so we've got that set up. I've got a pretty good template, I think, that will be helpful. So I guess we'll start with the normal procedure. We'll look at the PowerPoint and see if we can make some sense of this. And after that, we'll be able to do a problem or two together here. You know what the entry is to record depreciation expense. You know you debit depreciation expense and you credit accumulated depreciation. Okay. Here's now we're just going to figure out how to come up with the numbers, huh? Different methods. So here we go. Now we're introducing a chapter on not current assets, but fixed assets or long-term assets. I've never heard of long-lived assets, but you get the idea. These are assets that are going to be around for many, many years and enable us to run our business, make some money, huh? They can be tangible or intangible. I think we all know that a tangible asset is one you can hold, right? You can touch. We bought a forklift. We bought a car. We bought a building. We bought a gigantic threshing machine of some kind. You can touch them. They're right there. They're real. Intangible. Oh, you can't see them, but you know they are there, kind of like Santa Claus, like amortization. And what we do with those, what we're talking about there are patents, trademarks, copyrights, things like that, intellectual property of great value. And they're just fleshing this out, it looks like a little bit. Long-lived assets, land, and all these things are subject to depreciation. I'm going to back up a little bit. Assets, we depreciate. You depreciate assets, you amortize intangibles, and you deplete natural resources. So there's 3 different kinds of expenses we're going to be going over, huh? Land is never depreciated. It's an accounting rule. And I think the reason why is the feeling was land never loses value, but I'm not sure about that. So assets are subject to depreciation. Your patents are going to be amortized, natural resources, mineral deposits, timber, gold mines, etc. And here's what a typical balance sheet will look like for this section, huh? Southwest Airline, after their current assets are done, they go into their fixed assets. They have flight equipment, that must be planes, I guess. Ground equipment, that's all the carts and trucks those baggage handlers are dragging around. Then they had to make some deposits. You know, when they order a plane, it takes a couple of years to build a giant 747. So they have some beginning payments to make, upfront payments. And then assets constructed for other. For example, Southwest Airlines may have built a particular machine that they gave to Boeing to use, something that's specific to them. You subtract the I don't like that word, allowance for depreciation. Well, okay, since they at the end, you subtract your depreciation, amortization, and depletion. There you go. You got net. You got your good, your net fixed assets. Okay. Goodwill. We're going to get into that, I believe, in this chapter. Goodwill is simply an amount of money in excess of. It's the difference between what you paid for a company and its actual value. And we'll talk about that. Okay, here we go. The first part of this chapter, This will be on the test because these make for good multiple choice questions, and it's an important concept, huh? Acquisition cost includes the purchase price. We knew that, but it also includes any expenditure to get that asset ready. Oddly enough, it doesn't include any borrowing expenses until you bring the machine in, okay? Acquisition costs. We bought a machine from Boeing in this book at $78 million. We might have to pay a sales tax on that, which would become part of the cost of the item, right? Transportation cost. United Airlines hub is in Chicago. Boeing makes the planes in Los Angeles or Seattle. Getting that plane from Seattle to Chicago is part of the cost of the buyer. That goes into the asset. Any legal fees, installation cost is important. You buy a big fixed asset and you have to knock a wall down in your factory, which I've seen done. You have to knock a wall down in your factory to bring it in. The cost of knocking that wall down and restoring it becomes part of the cost of the asset. And here's a word we've used a little bit, capitalized. When we say something's capitalized, we mean we consider it an asset. It's an expenditure of cash that is ultimately an asset. You capitalize it. Capitalize, measuring and recording. So, I mean, I think they do a pretty good job in this part of the book on these acquisition costs. Equipment. We buy a machine. We have to renovate our own factory to bring it in. We have to do something else to bring it in. We have to pay to bring it in. Land, well, we just bought an acre of land in Santa Barbara for $10 million, but we're not going to debit land for $10 million. We're going to debit land for $10 million plus the $100,000 real estate commission, plus the premiums, plus the delinquent, etc. Anything that's involved, building, same thing, okay? So the whole point of this is acquisition costs, the amount that we're going to capitalize is not just the cost of getting title to the goods. There's a lot more to it. So we're going to get into some examples here. On January 1st, Southwest Airlines bought an aircraft for $75 million, huh? So that seems to be a fairly innocuous purchase. Now, what they're going to show you here with the next couple slides is Southwest has various options on how to finance this deal, just like we do. You know, we can choose to pay cash if we're lucky enough to do that for something, or we can charge it or take out a loan, or maybe a combination of the two. So there's some different ways there. We certainly know, though, that the debit is going to be a debit to, I guess, flight equipment for $75 million. And here it looks like they're putting $1 million down and the rest they're taking out a note. So what would be our journal entry? We bought a plane. Okay. Here, they're giving you an example. They bought it for cash. Not so hard, right? I want to go back to this. Yeah, they never did show us this journal entry here, right? Anyway, this journal entry here where they paid cash of $1 million, you debit the flight equipment, credit cash $1 million, credit notes payable. They bought a plane for cash, huh? Boy, that's nice to have 75 million lying around, huh? Okay, now here they did it the other way. Here, they're gonna put just a little bit of money down and borrow the rest. So let's take a peek at the journal entry. That's the original journal entry. I'm not going backwards, this is going forward. Finally is what I'm looking for. Look at that journal entry, huh? We debit flight equipment, that asset goes up, and we exchange another asset, cash goes down, and we took out a note. Hi, Prasanna.
Persiana.
Say it again, please.
Persiana.
Prasanna, how you doing?
Good. How are you?
Are you a fellow Russian by any chance?
Bulgarian, but really close.
Well, that's close enough. Yeah, yeah. My father's from the Ukraine,
Oh, that's cool.
so we're both Slavs, right?
Yeah.
Okay, we're both Slavs. All right, welcome. Say it one more time, please. Your name, Persiana.
Persiana.
Okay, Persiana. We're just starting off in chapter 8 here on fixed assets. Okay, and we just went over when you buy an asset, the capitalized cost is going to be probably more than just the price of the asset. You have to add to that various expenses that are required to get that machine into the building. And that's kind of where we were right now. We wrote a journal entry here where we debited the equipment and credited cash for 75 million. And they could also buy it via borrowing money, huh? Here, they put 1,000 down and they financed the rest by borrowing via a note. Now, this can also happen too. You buy something and you're going to pay for it with a piece of your own equipment, believe it or not, huh? Record at the current market value, the consideration given, or the current of the asset required, which is ever. So look what happened here. Southwest gave Boeing 1 million shares of stock. Our value is $1. We don't care about that dollar. But the market value of that stock at the time was $50. So Boeing said, okay, we'll take the stock. We like your company. So what happens here? What happens here is this journal entry. This journal entry. They gave, let me just move this out of my way. I always have this little thing in my way. It's very irritating. Okay. Flight equipment, that's still a debit for 75 million, right? They gave up cash. And then they gave this company stock that's worth $50 million. That was the market price on that day. So just like you were issuing stock here, you're going to credit common stock for $1 million and credit the difference between the 50 million and the par value. You good with that, Kate? Okay. Oh, how you doing, Callie? I got your problem here for you.
Good.
Okay, here we go. We can also build the thing. If we have to build, we could build our own assets and all the material and labor and overhead, and the interest during construction would go to the cost of that item, huh? I doubt this will be anything on your test. It's just a note. It's just a note. Boeing wants to, Southwest wants to buy a plane from Boeing. They find out it's too expensive. So Boeing says, we'll build our own plane. And that's kind of what they're talking about there. Okay, now this is real important. It's real important because it affects a lot of the journal entries. Repairs versus maintenance versus improvement, okay? The difference between repairs and maintenance and improvements is quite important. They have two different trackings. Ordinary repairs, it just maintains the normal operating condition of the asset, doesn't increase productivity, doesn't increase the life. It's the kind of thing you have to do once in a while, and the dollars are not terribly big. For example, a company bought a $500,000 truck, okay? To keep that $500,000 truck running, they have to change the oil every month. They have to put $500 worth of oil in that truck every month. That is just an ordinary maintenance expense. They need to change the filters. That's just maintenance. That's just keeping that truck going. Okay, you get the idea. In our building, in our classroom at school, above us, we have the air conditioning system. Once a year, one of the maintenance guys has to go up and change the filter. That's just normal maintenance. That would be a debit to repairs expense or something like that, huh? Credit to cash or whatever. Now, an improvement is a different animal. An improvement, here, you're doing something major. There's some big dollars here. You don't do it much at all. And the result of doing it increases the efficiency of the machine or extends its life. And if you've been doing some of the homework problems, you saw a couple of those, right? Where they said, we have a machine, it's 5 years old. Best example, not best, but one example here, you know, you bought a company car, big 8-cylinder thing, you know, your car fan. So you bought this big company car for your sales manager to drive around. And that car lasts for 4 or 5 years and you've been doing maintenance. And then after 5 years, you decide to really soup that car up. You overhaul the engine and you put a big, giant 12-cylinder engine in that thing, which will then increase what that car can do. That would be an improvement. An improvement is capitalized, and capitalized, we just heard a few moments ago, means an expenditure that's going on the balance sheet. Anything that's capitalized, we're talking putting it on the balance sheet, not the income statement. So let's see what we have here. And here we go. Here's a little helper here, huh? Capitalized. If it's capitalized, we know we're going to debit a fixed asset, huh? And that the expense is going to occur during the many, many years we enjoy that asset, your depreciation expense. If you capitalize something, your income is going to be higher than if you expensed it, and your tax burden is going to be higher. If you expense something, well, obviously you're going to knock your income down, pay lower taxes, and the expense is immediate. Now, I believe Cornelia asked us to look at a video on some of these fraudsters recently. Some of the big name frauds, you've probably heard of it. You've heard me talk a little bit about Enron. I think there's one that you can look at, world.com out of Mississippi. What those crooks were doing, everybody, they were taking any of their expenses, just about every expense, and capitalize it, which is, you know, terribly wrong. And while they were doing that, they were recording higher income that was false. And using those phony financial statements, they were able to borrow more money, and the thing eventually blew up, and the guy went to jail, okay? This is a big, wherever I was working in factories, I told you, until I moved to Santa Barbara when I went with the clinics. In factories, you're always bringing in machinery, you're always working on them, and you always have arguments with different people over whether it should be capitalized or not. And that was always a big deal. Oh, here we go, world.com. Hiding billions through capitalization. When expenditures are recorded as expenses, that's terrible. In one of the largest accounting frauds, WorldCom inflated its income, and it turned big losses into big profits. They capitalized $4 billion worth of operating expenses. In other words, they increased their profit on paper by $4.8 billion. And in so doing, the public thought it was a better investment than it was. It bought shares in the stock, and eventually everything blew up, okay? Now we get into the guts. Depreciation, huh? It's an allocation process. We're allocating. We're taking the cost of that machine. We bought a machine for $100,000 today, and that machine's going to last us 10 years. We are going to allocate the cost of that machine over 10 years by debiting depreciation expense and crediting accumulated depreciation. So you buy the machine, goes on the balance sheet, debit machinery, and then for the next 10 years, you're going to be taking this machine and depreciating it down to zero or to its salvage value by recording depreciation expense. So you depreciate a fixed asset. You depreciate a fixed asset. And here's the allocation method. You debit that and you credit accumulated depreciation. That's an easy journal entry. That's the one I keep saying you want on the test, right? Because there's no thinking in terms of the debit or credit. Our next. And this is kind of important to understand. Depreciation is a cost allocation method. We understand that depreciation has nothing to do with the market value of the asset. Nothing to do with it. Whatever's on the balance sheet, whatever that amount is, probably does not represent market value. The undepreciated cost not measured on a fair value basis. This will be real important in about 3 chapters. The key thing is the net book value of an asset, meaning the original cost of the asset minus the accumulated depreciation at that point in time, has nothing with the net book value. And I think I told you we had a machine where I worked for all those years at Thomas & Betts, lead type machine, built around 1900. We actually had a machine where you melted lead and then you poured the hot molting lead into letter dies, and then you pressed them onto a press, and nobody does that anymore. That went out of business, 50 years ago. But Hollywood used to be a customer of ours, and they would ask us to do things like wanted posters for movies. I'm sure that machine now is worthless in terms of what you can do now in PCs. Huh? There's your adjusting journal entry, debit depreciation expense, credit accumulated depreciation. There you go. The calculation of depreciation requires 3 things to consider, huh? 3 things. We got to know what we paid for it, right? We got to know what the acquisition cost is. We have to have a life over which we're going to depreciate it. And we must know the residual value or salvage value. The residual value is an amount we estimate that we think the machine would be worth 20 years from now. That's all it is. For example, we buy a big forklift, and we estimate we're going to have that thing for 10 years, and for 10 years, we beat the heck out of it. That machine has been driven outside in horrible weather. It's rusting. We maintained it. And after 10 years, we figure we're not going to have that machine anymore. We estimate $500 residual. We think a junk dealer will come in here and haul it off just for the metal. Residual value, huh? And then we're going to get into our 3 methods, and there are more methods than this, but these are the 3 that we choose. Straight line. First of all, straight line is probably what most companies use because it's easy, because it spreads the cost out evenly from year to year. And so what do we have here? We have Southwest Airlines buying ground equipment, and it's only going to last 3 years. How about that? Need a shot of my whiskey here. $62,500 is what we paid for it. But the residual value is $2,500. Why is that super important? Because you do not depreciate the residual value. When a piece of fixed asset equipment is fully depreciated, the net book value must equal the residual value. You never ever bring the net book value below the residual value. If there's no residual value, then it's zero. It makes it a little bit easier. So take a quick look at your simple little formula here. The cost of the machine minus the residual value gives you an acquisition, not an acquisition cost, gives you what's called the depreciable cost of 60 divided by 20 gives you 3 years or 20,000 a year. Okay. Let's take a peek here. So does anybody have any questions with that? That's not too tough so far, right?
Mm-mm.
Okay, I'll go on. And this is just for information purposes. The differences in estimated lives within a particular industry. Look at Southwest. They estimate their planes have an estimated life of 23 to 25. Continental, United Continental, same thing, 25 to 30. Look at Singapore though, 15 years. Does that mean that Singapore's planes are safer? Does it imply anything about which airline you might like to fly in terms of safety? No, I don't think so. Singapore is choosing 15 years because I'm guessing they want to show a lot of depreciation expense every year and thus mitigate their tax burden. Singapore Airlines buys the same planes that Southwest and United. They all buy from Boeing, probably. But Southwest says 25 years. We're going to divide by 25, and Singapore only divides by 15.
Didn't the book kind of mention that the reason why Singapore, for example, Singapore Airlines might have a higher depreciation is because of the fact that they buy secondhand plane?
Good point. I don't remember that from the chapter.
Yeah.
Sure,
So basically, when it comes to like Southwest, United Continental, they're always trying to keep above like they're trying to keep up with trends. So the 747 Max and whatnot, and then that's how basically Southwest and United get to call also some money because they made money off of planes that when they went ahead and sold to countries like Asia, South America, and stuff.
That's great. What a great observation. No, I kind of forgot that actually. I've only been teaching this thing for like 5 years. But yeah, that's a real good explanation. Singapore, they're buying older aircraft and they're not going to last as long. That's certainly going to be a reason. The other reason that I was going to get to is there's a certain leeway in terms of how many years you can estimate an asset. In other words, these are aircraft, major aircraft. When Singapore bought those used planes, which are obviously in flying condition, in good shape, could Singapore say we're going to depreciate it in 1 year? Could they do that? Not really, no. There are some guidelines from the Financial Accounting Standards Board. No, an airline can't buy a $75 million plane and then say, well, we're going to depreciate it in 1 year. And that way we're going to show a big loss and we don't have to pay any taxes and we can easily explain the loss. No, you have to be within a reasonable range here. Okay? So if Singapore is flying older airlines, that's good to know for purposes of purposes of traveling. Thank you for that, George. That was great. And the differences in the estimated lives residuals can have a very significant. So here we go. We're back to straight line. They're kind of repeating it, looks like. There is our calculation. 60,000 divided by 3 is 20,000 a year. And this is your template. Say hello to your template here. Your template. You're going to have, starting on the upper right, this number here will include the residual value. You're not going to depreciate the residual value, but you are going to include it at the beginning, and then you're going to record your and your annual depreciation, 2020. 2020. These two columns are your journal entry, and this is the accumulated balance. So after the first year, we debit depreciation expense, we credit this. Our accumulated depreciation balance after the first year is 20. After the second year, the accumulated balance is 40 and then 60. And we are left with a balance that equals the residual value. That's exactly where we must be at the end of the depreciation. Okay? I think we're okay with that one. Units of production method, huh? This is, if you understand this, you will also understand depletion when we get to that in a little while, huh? Okay, let's see what we have here. Under this method, we're doing the same type of calculation. We're taking the cost of that 62,500 and we're subtracting the residual of 2,500. And now we have the depreciable amount of 60. But we're not going to do this by year. We're going to do it by mile. By miles. Okay? This ground equipment, this could be a car or something. We're going to do it by miles. So we go $60,000 divided by 30,000 by 30,000. I'm sorry, here we go. By 30,000. Here we go. 60 cents a mile, right? 100,000 miles. I kept saying 30,000. That was the first year. We bought this particular item for 62.5. We have to subtract the 25. We expect this thing to last for 100,000 miles. So every mile we drive this car, we multiply it by 0.6, and that becomes the depreciation expense for that year. With this method here, you have to keep track of the miles. You know, again, I don't know if it's the same way now. This is a long time ago, but where I worked, we had a lot of salesmen driving around territories, and they had to keep careful track of the mileage on the car, okay? Units of production method. I love how they repeat these, and here we go. Here's what it looks like when we're done. Anybody have a little trouble with that one, or does that one seem pretty easy? Shouldn't be too hard. You good, Kelly? You're good, Kelly?
Yeah, I'm good.
Geez, poor Kelly.
Yeah.
Okay. Accelerated depreciation. Woo! Accelerated depreciation. Here, what we're doing is we are not throwing in the depreciation evenly. We're allowed to front load it somewhat if we choose. Accelerated depreciation matches higher depreciation expense, higher revenues early in the period. So on this method, we're going to show high depreciation expense, and later years going to be low. I'm ignoring that note about the repairs here because I don't know what they're talking about, to be honest with you. In the early years, the repairs will be low, I guess. Then as it gets older, you need to repair. So this is the one where you have to think a little more. Double declining balance. Double declining balance. Double declining balance means double what? Does anybody want to guess what you're doubling? Anybody remember from reading the chapter or anything? You are doubling what the straight line rate would have been. What the straight line rate would have been. So if they give you a problem and they tell you that We bought an asset for $100,000. That asset is going to last us 5 years. That's 20% a year, right? And then they tell you it's double declining. Well, 20 times 2 is 40. That's how you get the double declining balance rate. It's double whatever the straight line rate would have been, okay? And the key difference is here you do depreciate the 62,500. You do depreciate that residual value, but to make things even more complicated, you still can never have a book value lower than the residual value. Under this method, as you go along, you're eventually going to find a year where the net book value goes below the residual. You have to stop and adjust up to get back to where you need to be. So here we go. We got the same asset. It was 3 years, right? That would be 1/3. 3 years. Take a look here. One-third is how we began, right? It was 3 years. So that's 1/3. 1/3 times 2 is 2/3. So under this method, we're going to take the full 62.5 because we do include the residual. And when we multiply that out, we're going to get a big number. $41,667 is what we are going to expense. A big number. How do we get to year 2 now would be a question. Year 2. Well, let's see. We started off with 62,500, and now we've reduced that to a book value of that minus 41. So take a look. The second year, we take the original depreciable amount minus the accumulated depreciation. In this case, it would be like 19,000 something, I guess. And we multiply it out by our 2/3, we get the second year. So let's all take a look at this. This is the tricky one, huh? Tricky one. But as long as you know, double means double whatever straight line would have been. If it was 5 years, 1/5, huh? Times 2 is 2/5.
Can you give us an example of when this type of method would be used, just so I can understand it in context?
Companies, that's a good question. Companies would use this if they want to minimize their income in the upcoming year. In
But
other
on
words,
what type of, what would be used as an example in terms of what items or what equipment or what asset would be depreciated?
well, I'll give you a good example. Computers, for example. Computers, you buy a laptop today or an Apple, what are we up to, Apple 11 or something now? You buy an Apple and in like 3 or 4 years, that's almost obsolete, right? As they come up with newer and newer items. So those are the types of things that companies make the justification. They say, look, we buy this, we bought this computer system from Oracle. In 4 years, it's probably going to be almost obsolete. Therefore, we have a short window to depreciate, so why not front load a lot of these expenses and at least give ourselves a tax break this year?
So why wouldn't you just use the straight line method and just do it over less years?
Well, you could, and that's what most people do. But there's a certain strategy here. This company here, whoever it is, they might be having a very, very successful current year. And they know at the end of the year, they're going to have to pay 30% taxes. By putting up this number, 41,000 instead of 20, they reduced their tax burden by 21,667 times 0.3. This is a big company here, so they save themselves, millions and millions of dollars of taxes. That's the real reason you would do it. Mitigate against taxes. Now going forward, they get less of that benefit. But they may want, another reason, Katie, they may want to make a big splash next year, perhaps. This year they have income that they want to hide a little bit. This helps them do it. Next year, when they don't get the same benefit, they can argue, oh, we did a lot better. There's a lot of examples, and it's common to almost any industry you can think of. You make a little bit of sense why you might do it, Kate?
I mean, I understand what you're saying, but I guess I need to read about it a little bit further.
Now, think of it this way: the choice of depreciation expense was either 20,000 straight line or 42,000 here, right? This company chose 42,000. 42 minus 20 is 22,000. And this is a big company. We know it's really 22 million. 22 million is an amount they don't have to pay taxes on. So they save 3 times 22 million. They save $6 million this year just by doing this. Next year, not so much. Okay. Uh-oh, what happened to our clicker here? And I need to move again. This thing is a depreciation expense is limited to the amount that reduces residual value, okay? And I'm gonna go, this thing doesn't wanna, okay. Remember our residual value was 2,500, right? We know that, they gave us that. We bought something for 62.5. Look what happened after the third year though. If you followed this formula, you would end up with a book value of 2315, which is lower than what's required, the 2,500. So you're just gonna have to go back and change that number to what you need to equal 2,500. Okay, this is the trickier method. Trickier, okay? And they're just graphing it. Here, a lot of expense early, little expense later. It's just strategic. Increased profitability due to an adjustment. Singapore disclosed that it increased the useful life from 10 to 15, and that had an effect of reducing their depreciation expense. Here, there's a real major change. And one last thing, when you look at the notes to the financial statement, they'll talk in pretty good detail about their depreciation methods, okay? Tax reporting, I'm not gonna go into that deliberately. Impairment. Here we do have to recognize a loss if the asset is no longer worth what we say it is on our books. We bought a machine, and now that machine was doing good work for us for years, and all of a sudden, the product that machine makes, nobody is buying it anymore. The machine no longer has any value to us. We have to record an impairment. And you recognize that impairment, that loss, when it suffers the impairment. Now, this is not a big part of the chapter, but here we go. We get rid of a machine. We get rid of a machine for different reasons, maybe because it's impaired, maybe because someone will give us something for it, or we lose them through fires or accidents. You recognize the loss when you suffer a permanent impairment, okay? This gets into much more detail in your chapter than it does in this one simple slide. So I'm going to suggest when you're doing your homework and you come to problems with impairments, don't don't hesitate to contact me. Texting is probably the way I'll get back to you fastest. Second fastest is my own personal email. Third fastest is the pipeline email, and then a Canvas announcement. Okay, now getting into one of my favorite things here, huh? Where I worked all those years with Thomas and Betts, we had so much old equipment lying around. We were always trying to sell it, dispose of it, okay? Disposal of property, plant, and equipment. I'm going to encourage you by pointing out when you get a disposal problem, you shouldn't even look at the numbers first. You should write down the debits and credits because they're always the same, huh? Always the same. Allow me to demonstrate. Getting rid of a piece of equipment, huh? We had a piece of equipment worth so much money. Somebody gave us cash for it. And maybe we actually got a gain or a loss. Regardless of whether it's a gain or a loss, your journal entry are always going to be the same. Always the same. You have to remove the asset from the general ledger, right? This means you've got to get the original cost off with a debit. We sold that $62,500 item. Remember that we've been working with? We sold it. We have to credit the asset, but we also have to debit the accumulated depreciation to get rid of the net book value. And they're giving you kind of a simple thing here. The difference between the cash and the book value tells us if we made money or not, if we have a gain or a loss, okay? Now, this can get a little tricky unless you organize your thinking. Here we go. The amount of depreciation expense recorded to bring depreciation up to date is, I can't see this, I have to move this. Oh, here it is. Here, I skipped that. I'm sorry. Southwest Airlines sold equipment for $5 million. The equipment originally cost $20 million and was depreciated using straight line. So it's $1 million a year. So did they make money or lose money on this? Well, this is pretty easy, huh? $20 million minus 17 million. For 17 million, I think they made a gain of, how'd they get 1 million? I'm a little annoyed here. They got cash for it. They sold 5. Oh, they're just showing you the depreciation. I'm sorry. We know that already. We know that. There we go. So the book value at the end of 17 years would be, if there's a God in heaven, we'll get this one right, $3 million, right? So that's not so tough. We sold it for $5 million. We made a profit of $2 million. Okay? So a note you could be looking at when you're doing your homework is cash minus net book value equals profit or loss. But let's not call it profit or loss. Call it gain or loss. Gain or loss. Prepare the journal entry. Prepare the journal entry. What are we going to debit? Someone gave us money, right? So we are going to debit cash. We know we have to get rid of the net book value, so we know we have to debit accumulated depreciation. We know we have to credit the cost of the asset. Any difference is a gain or a loss. My point is cash, accumulated depreciation, and the original cost of the fixed asset are three of these four guys. Cash, accumulated depreciation, flight equipment. How did they figure this out? Well, guess what? They added the debits and the credits. If you needed to credit to balance the journal entry, you made money, okay? Anybody have a problem with that one? Any questions? Seem pretty comfortable? Okay. Okay, now we're getting into not depreciation, depletion. Depletion. Depletion means you're consuming a resource, a natural resource. I'm depleting this bottle of soda. Here, we're depleting a gold mine, a coal mine, an oil well, a forest, sadly. You deplete natural resources. They come from the environment. They come from God, right? A non-current asset presented at cost. We don't need to worry about that. So here again, I have to move something that you can't see. Okay. Here we go. The total cost of the asset is the cost to acquire it, plus a lot more expenses, probably more than the land. We bought some acreage in Texas because we think we might find oil. We pay $1 million for the land, but it might cost us 10 million or more to explore it and develop it and get it ready. And we're going to allocate that cost over the units of production. Depletion is just like the units of production depreciation. Remember, we bought the car for $60,000 and we're going to drive it 100,000. It was 60 cents a mile. Here, it's going to be so much per barrel of oil. So, depletion. We do have a residual value to subtract. We divide it by the estimated barrels of oil, huh? Where do we get that estimate? It's a good faith estimate based on what our scientists tell us, our geologists, our computer modelers, our mathematicians. They study that land and they think we're going to extract 1 million gallons of crude oil. So here we go. Again, they don't go into the detail I would like. So we have a rate of depletion times the amount of units. That's what goes to the cost of goods sold. And then the depletion minus that inventory unsold. This is just a dreadful, dreadful slide. Very simply, $1 million oil well that's going to spit out 10 million barrels of oil. It's 10 cents a barrel. Okay. Here is something that's more popular in your chapter. Intangible assets, intangibles. Can't see them. Can't feel them. You know they're there. You know they are there, huh? Non-current assets, no physical substance. Useful life can be hard to understand. You buy them for a reason. And they have exclusive rights or privileges, huh? A patent, a copyright, a trademark, a franchise fee. A lot of different things are intangible assets, and there are reasons for these rules, okay? Now, I think you'll find this interesting, and it's also part of the chapter. There's a company out there that is working on a cure for baldness, right? And this company's been working and working for years and years. Now, if tomorrow they announced that they had a cure for baldness, that all they had to do was rub this stuff on my head for 5 minutes and I get a big mop of hair back, that company will make a fortune, obviously. They have a patent, they get a patent on it. They have a patent that's worth tons of money, and you can't even measure it. But that patent cannot go on their balance sheet, interestingly. The reason for that is all the years they were trying to find a cure for us cue balls is every penny they spent was expensed. Research and development expenditures are expensed. So they get that benefit of not paying taxes on all of that investment. Now they own the patent, but the patent cannot be their asset on the financial records. They can hang it on the wall and proudly produce the product, and their patent protects them. No one else can produce this cure for baldness, huh? Now, here's what we're talking about in this chapter, and I went out of my way deliberately here. The only parties that actually have the patent asset on their books are the parties who buy the patent, who buy the trademark or copyright. Yeah, your company invented a cure for baldness. You're holding it right in your hand. You've run tests. You now have approval from the FDA. But you don't know how to really mass market it. You don't know how to mass produce it or advertise it. You don't know all the legal shenanigans that go on. So you might say to yourself, I'm going to cash in this way. I'm going to sell that patent. And you sell that patent to me, and you sell it to me for $1 billion. That's probably cheap. Well, you get that $1 billion, you credit cash, and you park a credit and gain on moving a patent around, and you're done. Now I own the patent. Now I am able to amortize it according to the proper rules. Only a purchased intangible asset goes on a company's balance sheet. Very important. Talking about intangible assets. They have to have a definite life, and we're always using straight line. If you don't know what the life of the asset of the intangible is, you can't amortize it. All you can do is make sure it still holds its value. And amortization is quite similar to depreciation. It's even easier though, because there's no such thing as accumulated. There's no such thing as accumulated depletion. You will credit the patent. In other words, your journal entry would be amortization expense - patent, credit patent. And getting to the end of this chapter, and this is kind of the trickier part of the chapter, I think, but I also hope it's interesting. I mean, you're all business people. You're majoring in various business disciplines. Goodwill. It occurs when one company buys another, and only purchased goodwill we're talking about. And it's the amount by which the purchase price, exceeds the fair market value of what you bought. I own a company, and that company on paper is worth $1 million, okay? And you look at my company, and you say to yourself, well, Bob has that building there that has increased in value, so I know really his company is worth a lot more than the $1 million. It might be worth $2 million. So you come to me and you say, I'll give you $1 million for your company. I say, no, I don't want $1 million. That's not enough. You offer me $2 million. I say, no. You offer me $3 million, and I accept that $3 million is the goodwill. The $3 million minus the 2 is the goodwill. And hopefully they'll go into a little more detail here and they don't cut us off. And goodwill is not amortized. not amortized. And here we go. And I'd like you to try to follow this. You're probably not going to pick it up real comfortably at this moment, but I know it'll be on the test. I know it's in your book, and we do want to practice. RPEC paid $2 million to purchase a company called UTEC. UTEC had assets of so much amount and liabilities of 4 million, okay? You notice they're not telling us what the equity was in this company? It's because we don't care. We paid $2 million for this company, and the acquired assets we think are worth $1.8 million. We have to, of course, pick up their liabilities. So how do we calculate the goodwill? Well, the goodwill is the 1.8 million fair market value, not their number. Nah, that went too fast, but take a look at it. We bought assets worth $1.8 million. On their books, those assets might have only been $100. We don't know. We don't care. We're allowed now to figure out what the fair market value of this company is. We determine it's worth $1.4 million. We offered this guy $1 million. He told us to get lost. We offered him $1.4 million. He said no. Eventually, he accepted our offer of $2 million. We paid $600,000 more than this company is actually worth. Why would it come? Why would we do that? Anybody want to tell me a little bit about that? George, you're a business person, right? Why would you pay so much for my company? I'll tell you why, George. You want to know why, George? I'll tell you all why. Because the person running this company, to me, is an idiot. He has a company with great potential. And I think if I buy his $1,400,000 company for $2 million, I can now introduce my customers to this guy's products and his technology, and I'm going to make back that $600,000 in no time. That's why you do it, because you think there's a better future for this company. Okay? And what are some of the different things? Trademark, Visa, the McDonald's arches, a symbol, a logo, an exclusive legal right. Record them at cost, copyrights. You publish a book. You publish a book, and the legal life is the life of creator plus 70 years. So you're pretty well covered there, huh? After you die, 70 years after you're dead, no one can steal that from you, right? And again, it's amortized over what the life
Wait,
is.
they can't take it after the creator's life plus the 70 years?
The legal life of a copyright is the life of the creator, plus 70 years.
And after that, what happens?
And then after that, it's in the public domain. Anybody can do anything.
Oh.
So
like, for
someone
example,
can buy it?
Like, for example, right now, if Abraham Lincoln wrote a book, let's
Exactly.
say, he's been dead for quite some time now.
Yes, he
He
has.
basically has no copyrights over that anymore.
That's right. Anybody, that's exactly right. Like Moby Dick or something like that.
Can you go ahead and say, hey, I said this?
Say what?
Like, for example, if he said a phrase, and then obviously he had copyrights over that for a certain amount of time, and now the copyrights are over and stuff, and you say, hey, you know what, I said it. Basically, at this point, because it's public domain, you can copyright it now.
Yes, you can do. Yes, that's exactly right. Like in my cue ball, my bald dream, some medicine that could fix my skull. If you're the guy who owns the patent and you choose to make that product, that patent is good for 20 years. After 20 years, anybody. That's how you get the generics. When you go to the pharmacist, the generics, they can start making that product as soon as the patent period is over.
Okay.
And companies play a lot of shenanigans with that too. Go ahead. I'm sorry, George.
But for example, like, all right, let's say iPhone. The iPhone was not introduced until like probably like early 2000s and stuff.
Mhm.
And then you have these generic chargers and stuff.
Yeah.
And like generic aux cords and whatnot.
Mm-hmm.
Are they like, because a lot of these items are made in China and stuff, or in other countries are cheaper to be made and produced. Are they subject to the same copyright rules, or they don't have to go by the copyrights?
Well, that wouldn't be a copyright. That'd be a patent, and patent's 20
Oh,
years.
the patent, but they could go ahead and do it even if they're in a different country, or just patents only pertain to the U.S.?
Oh, no. If China goes ahead and builds an iPhone, no, we would bury them. We'd be suing them in world court. We'd be slapping sanctions on them.
Okay,
That
so
would
for
be
the
a terrible, not to say it doesn't happen. It does.
Yeah.
But yeah, I mean, you guys haven't spent much time in New York City like I have or I used to. You walk around Midtown Manhattan, you have all these shady guys on the corner selling phony Rolex watches, for example, stuff like that.
But
Yeah.
if, for example, like right now, if let's say Venezuela decides to make a phone like it, we could go ahead and sue them because technically the patent is still within 20 years.
That's correct. That's
Right now,
correct.
just a whole charger is not worth it.
Right, exactly. And don't forget that Microsoft, and not Microsoft, but Apple and other companies, they're always coming out with new versions, and that starts the cycle over, for the new version. And fine, if you want to make the old version in 20 years, I guess you can do that. Okay. Trademarks, copyrights, that's books, huh? Books. Now, patents, we're going to go with a 20-year period. Patent works is exclusive for 20 years. It's an exclusive right granted by the government to manufacture an invention. And the cost is all your research. Let me start. Let me say that again more correctly. Patents, exclusive right. The cost is what we paid for that patent. Remember what we said? The only people who have a patent on their balance sheet are those who bought the patent from the inventor. And it will be amortized at cost. The cost will be amortized over a maximum of 20 years, or it might have a shorter useful life. The patent clock begins the day the patent is approved. So if this guy invents my baldness cure and we buy the patent in 3 years, we've got 17 more years of exclusivity. Okay? All research and development costs coming up with a patent are expensed. And that's a whole other world in accounting. And certain technology, huh? Your website. And obviously this changes, huh? As more and more technology comes out, different things, franchises. You spend a lot of money to open up a McDonald's. I don't know if you're familiar with this, but it takes a lot of money to become a franchisee of a franchisor rather of McDonald's. It costs millions. But that protects you against people open up a restaurant next to you called McDonald's. They can't do that. And then licenses and things. Focus on cash flows. I'm not sure I want to look at this here. Okay. Let's just look at this briefly. This will help us going forward. What's the effect on cash flows? Depreciation and amortization have a good effect on cash flows, right? Those are expenses that don't cost us any cash, and yet we don't have to pay tax on it. Gains, losses, Okay. Now here I am going to get into the supplement. This is one chapter where we do want to get into the supplement a little bit. Getting back to depreciating fixed assets. Sometimes a machine doesn't seem to be lasting as long as we thought, or we make that machine even more worthwhile, which means we have to come up with a new basis of depreciation. If the estimates change, the book value less any residual value is depreciated over the remaining useful life, okay? Again, you just got to do a homework problem or two. Here we go. Southwest bought a plane for $60 million. They're depreciating it for 20 years. Residual is 3. In year 5, and I'm assuming that's at the end of year 5, Southwest changed the estimated life to 20 years, and they lowered the residual. What we have to do is know what the net book value was at the time of this change, because that's the remaining amount we are going to depreciate. I said net book value, I meant to say the depreciable value, the undepreciated amount at the time of the change. We now have to divide that by its new remaining useful years and consider the new residual. So here it is. Purchased an aircraft for $60 million, and we were depreciating it, it looks like, at a rate of $2,850 per year for 4 years. So this change is happening after 4 years. We bought an asset for 60 mil. 4 years worth of accumulated depreciation came to 11. Now we have to depreciate this over the remaining 21 years, because this change occurred in year 4. After year 4, we have a new residual. There's our new base. Confused, everybody? A little tricky, huh? A little tricky. This is what we were doing. We bought this machine for $60 million, and we had a certain amount of residual. So we were taking that 57 million, whatever it was 60 million minus 3, 57 million divided by 25. That's where we got this number. Now we're making a change. We're making a change. We have a new residual value and we have new year. So we go back to where we were and just work with the new numbers. End of chapter 8. Chapter 8 is a little tricky toward the end here, I think. Try to keep in mind the difference between depreciation, depletion, amortization. Disposal of a fixed asset. If any of you get that wrong, I'm going to be pretty annoyed, because all you have to remember, it's the net book value minus whatever cash you got. And your journal entry for that is always the same. Debit to cash, credit to the asset, debit to accumulated depreciation, and then you just add the debit and credit column and the high man wins. Anybody have questions? Callie, you wanted to look at something, right? Is Callie there? Did Callie leave us?
Yeah.
Okay. All right. Well, I guess I'll call it a meeting. I'm going to work with Callie on a question sort of along these lines here. Hopefully I recorded this thing properly, and it'll be up on the Canvas shell shortly. And I've been putting them up on my YouTube channel only until the end of the semester, at which point I will remove them from the public domain. Okay. So we call it a meeting then. We're all ready to roll. All right, Danielle, everybody give me the famous raccoon wave. Woo!
Thank you.
Okay. Bye-bye. See you, George. Bye-bye, everybody. All right, Callie, are you ready?
Yes.
Okay. Let's see. You gonna stick with us, Giovanni?
No, I'm about to head out. Thank you, Bob, though.
Okay, go get him, pal.
Thank you.
Bye-bye. Okay. You saw that video I sent you with the raccoon wave now, right, Callie?
Yeah.
That was the funniest show on television. Someday you should show that show to your daughter. I mean, it was only on for 1 year in 1955. And back in New York, they still show that. Anyway, the raccoons. Okay. All right. This problem here is sort of what you were just talking about in your problem, I think, right? Similar?
Mhm.
Okay, I think I have it here. Hold on. Okay, hold on.
Mhm.
Okay, this is what you sent me, right?
Yes.
Okay. This is a company in Germany. They publish scientific things, books, and they assume that they got a big press, a big printing press, huh? To
Mhm.
get those words on paper. It cost them $490,000, and it was being depreciated for 20 years, right?
Yes.
It had a residual value of this. Okay, so you take 490 and you subtract the 59, right? To get the
Mhm.
depreciable, and then you divided it by 20, and
Yes.
they did that for 5 years, right?
Yes.
After 5 years, they decided that because they figured out better ways to maintain the machine, they found better oil or something. We think that this machine's not going to last 20 years. We think we get an extra 5 years out of it, 25. And now you have a new residual of 78. So let's take a look at, let's take a look, come here. Okay, well, here's what they originally did, right?
Yes.
And they had the salvage. So that was your annual depreciation expense, right?
Yes.
You recognize that number, right?
Yes. The number one. Yeah.
Yeah. Okay. So you're good up to that point. The next step now is to consider what they're telling us. They're saying after 5 years, this machine has 25 more years to go, or 20 years. On this part, I'm not sure, to be honest with you, okay?
Uh-huh.
So all we have to do is work with the new residual value, work with the remaining years, which I think is 25 because it came out to an even number. The other number was all shkadlats.
Mhm.
And we just have to know what was the net book value when we made the change. So the net, and do you have the problem up on your machine? Maybe you can put the answers in and see if this works, if you want to do that.
So the net book values after 5 years.
Yep,
Oh.
is that number, right?
Oh.
We,
Yeah, I confused that. I don't know how many years. Maybe 4 years.
what's not clear in this problem is they talk about going from 20 to 25. And at first I thought they meant an additional 5 years, but I think we have to start with 25 again.
Mhm.
But here, can you take a picture of that? Is that possible?
No.
Okay. Does that kind of get you going though, in the right direction here? I think these numbers are going to be right. The only question is this number, should it be 25 or 20? And 25 gives you a crummy, well, it could be 25. I'm really not sure.
First said 20 years, and after 5 years.
It was original. What they did was they added 5 years to the life of this machine. So I'm pretty sure that 20 is the right number. Okay.
Oh yes, I got. Yeah, I cleared the netbook value after 5 years. So this number.
Is that the right number?
Yeah, yes, this number.
Is that where you were stuck?
Yeah, I confused it. Yeah.
Oh, it is. It is confusing when you first see it.
Yeah.
Yeah, yeah.
Yeah.
So then,
clear.
what's the next question they're asking then?
Did you receive my first email?
Yeah, I have it.
Yesterday night.
Yeah, I have it right here. Oh, the first email? Let's see what you got.
Yeah, yesterday night, first email.
I saw it. Yeah, you did. Okay. Okay, hold on. Come here, you. Okay. Okay. Oh, the one with the form is complete?
Yeah.
This one I looked at. Let me bring it up, okay? We'll share it. Share and share link. Okay. Oh, wrong thing, right? Hold on. Hold on here, I screwed up. Okay, give me a second to get back in there, Callie. I'm sorry.
That's fine.
Hold on. I can't find the toolbox. What the heck is going on here? Come on. Ha ha! Now I see it, I think. We don't need this anymore. Ah, we don't need, I'll leave that up. Minus. Oh, finally. Okay. Finally, finally, finally. This thing is playing. Give me another moment. I'm getting there. Share. This is what we're talking about, right?
Yes.
Okay, let's take a look at this. There was something I didn't like about this, and I'm not sure. Okay, all the numbers start here. They bought a machine, they bought a building for 752, half depreciated. Okay, so it was depreciated by half, okay?
Yeah.
So that's your beginning balance they're giving you. And then they're telling you they had repairs of 8,000, which you took out of cash, and that's right.
Mm-hmm.
And then here's the part, extensive and major repairs, okay? So you're good here with the cash, all right? I
Yes.
noticed you added it to the building. I'm not sure that's correct. It says extensive and major repairs, but it doesn't say that it increased the value of the asset. So I don't know if the 26 belongs there. I'm thinking it belongs there with the 8.
Repair expensive?
Extensive and major repairs.
Mm-hmm.
They're repairs.
Mm-hmm.
Repairs is an expense. It's a big number, and you may be right putting it there, but it's not really telling you to do it. I think that 126 goes over here.
But it said that's right. Building.
Say that again.
It's right. Right.
Okay. So this is correct. You're telling me this number's good then, huh?
Yes.
Okay. See, I wouldn't. That's why I'm questioning it. It's a big number, so you would think it is an improvement, but they're not using the right words. But okay, 126. And then what happened for 240? Now you increase the building. Depreciation expense.
I think I all write it down the number, but it said is not complete.
Okay, let's see. Balance is good. And then the next depreciation. Yeah, I hate these. Beginning. This is your depreciation expense, right?
Yeah.
And that's the 752 divided by
752, 16,
Yep.
16 years.
Okay, that's 752 divided by 16, right?
Yeah.
Okay. So your accumulated depreciation goes up. You see this 47,000 here?
Where?
That 40,000 there?
Yeah.
Does that belong there? Balance prior to expenditures. Again, they told you that that number's right.
Mm-hmm.
Is it fair to say that everything on this is right? It's just they're telling you it's not complete.
Yes.
You know, we've been working with McGraw-Hill a long time, and we never had these kinds of problems before. I think you did everything good here. You're not supposed to put in a bunch of zeros. Oh, wait a minute, Kelly. What's here? Cash. Oh, I think you need to put something in.
It's nothing. It's
I bless it. It's okay. In my church. Turn it in, Callie. Don't worry about it. It looks good.
Okay.
I'll look at it again, but I don't think so. So You okay then? Because I don't know what to tell you. Do you talk to any of the other students in the class?
No.
Maybe, you know what you might do? Throw this up on a discussion. You know, just say, hey, anybody
Yeah,
running?
did anybody ask you the question?
Yeah, you're the only one who asked this question.
Okay.
But that might mean you're the only one doing the homework. I don't know. Okay. I hope that helps. Is there anything else I can do for you?
Mm-hmm.
When is your test? Next week? Or is it this week?
You said this week,
Saturday, right?
Thursday. Saturday?
Thursday? Today's what?
Today is Tuesday.
Okay. You're not taking the test Thursday, are you?
I don't know. It's Thursday.
No. I think Thursday would be a test review,
Oh, review.
and then the test will be over the weekend.
Okay.
I hope. Otherwise, you guys are in big trouble, right?
Yes.
All right, you all set then?
Yeah, I'm done. Thank you.
All right, I'm going to send you a little more of my favorite television show.
Okay.
You know why? Because someday your daughter should become an expert and make sure that she brings that show forward to future generations. Ralph Cramden, he was a poor bus driver in Brooklyn, New York. He was so funny. All right, well, you take care then. You know, woo-woo. We'll see you later.
Okay.
Bye-bye.
Bye.
Bye-bye.